Many people who study smart money and are being trained by ICT sooner or later face the same problem. Everything seems clear: structure, liquidity, sessions, models. But one feeling remains that something is missing. You have probably noticed that on one day, the main manipulation takes place during the London session, and on another, during the New York session. Sometimes the market shows false movement in the morning, and the real direction only appears in the afternoon. And every time there is a question: how to understand when real manipulation is taking place and when it's just preparation. Quarterly theory helps with this. There is plenty of information about it on the internet, so I won't go into detail about the theory itself. Instead, I'll show you my vision and how I combine quarterly theory with context to understand not just the market, but the logic behind the algorithm. If you are interested in a special video dedicated solely to quarterly theory, please write about it in the comments. If I see interest, I will do an analysis showing how to use quarterly theory alone in your trading. And so that you understand what we're going to talk about next, you need to remember the basics of quarterly theory. If we take the classic logic of smart money, market movement is based on the AMD model: A, accumulation, where the market collects liquidity; M, manipulation, when extreme points are knocked out; D, distribution, or true movement. But in quarterly theory, a fourth phase is added to this model: X, which stands for expansion or extension. This is the phase where the market either continues in the main direction or reverses if the cycle has run its course. In other words, AMDX is not just a pattern that can be found on a chart. It's a framework that explains how an entire period develops, from start to finish. The year is divided into 4 quarters, and each quarter corresponds to the phases of AMDX. But another important thing is that the structure is fractal. Within a year, there are 4 monthly mini quarters. Within a month, there are 4 internal weekly quarters. And despite having 5 trading days, the week is also divided into 4 phases, because Friday is almost never considered an active phase of the cycle. It's a day for fixing positions and preparing for the next week. So we get a cascade of cycles. The annual AMDX includes the monthly AMDX, the monthly includes the weekly includes the daily, and so on. And when you understand which quarter of the cycle the market is currently in, it becomes much easier to determine where manipulation will occur and where the real movement begins. Many try to explain the chaos of the structure, but don't take into account that the market may be in phase M or X, where movement will always be unstable and unpredictable if you don't see the whole cycle. To see this cycle on the chart, it is important to use the correct time frames. The year and quarter are read using monthly candles. Monthly mini quarters are read using a daily chart. Weekly cycles are visible on H1. And within the day, the AMDX logic works on M5. If you choose the wrong time frame, you will be looking at noise rather than the cycle phase, and most movements will seem random. And in this video, since I'm going to show the quarterly theory in conjunction with the context, the weekly cycle will be key for me. And the main time frame on which all this will be read most clearly is H1. It best shows the change of phases, the manipulations of the week, and those moments when the algorithm begins to form the true direction. Before I show you how to apply the logic of quarterly theory in conjunction with context, you need to remember a few more variables, without which the further explanation simply won't work. These are the basic elements of quarterly theory, and if you understand them now, all the subsequent steps will become much easier. First, the opening of the week. According to quarterly theory, the week does not begin with the Asian session on Monday or at 0 o'clock on Monday. The beginning of the week is considered to be the opening of the New York session at 8:30 a.m. New York time. It is at this moment that the real liquidity of the week is activated, and it is this price that forms the weekly open. I'll show you on the chart where to mark this time correctly. It's important for you to indicate it strictly according to New York time, otherwise the weekly context will be distorted. The second is the opening of the day. Technically, the day starts at 0 o'clock, but that doesn't matter for the algorithm. The real opening of the day is again at 8:30 a.m. New York time, the start of the New York session. Remember, if you use the wrong opening time for the day or week, you automatically lose half the meaning of the quarterly theory. The algorithm works according to New York time, and if you shift these points even by an hour, the context will be false. So now let's take a detailed look at how I view the chart, combining context with quarterly theory. I only should say one thing. In my system, I deliberately ignore Monday and Tuesday. As you know, it is on Wednesday that the main manipulation within the week most often takes place, and it is with this zone of manipulation that we will work. I mark the opening of the week on the chart. Now, it's important to note that if we focus on the true weekly open, then everything above this level is a premium, and everything below is a discount. This is a basic filter that helps us understand in advance where it makes more sense to look for sells and where to look for buys. We can also see that Monday and Tuesday formed a range, the very range accumulation I mentioned at the beginning. Now let's move on to the context. We have fractal liquidity zones, one right above the range and another slightly higher. Both of these areas coincide with my poise in the form of fair value gaps, which I use almost all the time. And if we know that most often on Wednesday, the market forms either the maximum or minimum of the week, then we can assume two scenarios. First, the price goes up to the upper fractal, removes liquidity, and forms a weekly high. This will be the manipulation. Second scenario, the price falls below the weekly open, removes liquidity from below, and forms a weekly low, after which I will look for buys, but only if there is a reaction. Now let's look at Wednesday's opening. Technically, it's at 0 o'clock, but the chart shows that the price in London has already delivered above Monday and Tuesday's range, removed liquidity from the fractal, and the price is reacting to the POI in the form of FVG. After that, I wait for the true opening of the day, that is, the opening of the New York session. On the lower time frame, you can see how the price forms a new fair value gap, and the flow of orders at this moment turns towards sellers. This gives me a confirmation. Manipulation has already happened this week, and I open a trade with a target at the opening level of the week. Many people might say that one trade per week isn't enough, but now look at the real movement that the market formed after the manipulation was confirmed in the weekly cycle. One such movement will give you more profit than dozens of attempts to trade every day without understanding the cycle and without understanding where the algorithm did its main thing. Now let's move on to EURUSD. Here I will show that this logic works in exactly the same way. Whatever the market is, it moves according to the same algorithms. And when you know how to distinguish them, you have a serious advantage. So let's repeat the same sequence of actions. Skip Monday and Tuesday and mark the opening zone of the week. In this case, the price was already in the POI, in the fair value gap on the 4-hour time frame. From Monday, liquidity was forming from above, and I think you understand that such formations are most often taken out. And again, we return to our logic. Wednesday is the day when the maximum or minimum of the week is most likely to form. In other words, the day of manipulation. Yes, there is no such a clear range on Monday and Tuesday as in the previous example, but we have the key point. The price has entered the zone of interest of the higher time frame. There is clear liquidity above, which the market left intentionally. And as soon as the price withdraws the liquidity of the previous day with additional confirmation, we can assume that this is the true manipulation of the week. Next, everything is the same as in the example for NASDAQ. We wait for the New York session to open and mark the true opening of the day. Already at the opening of the New York session, we see aggressive liquidity withdrawal, followed by a reaction and the formation of fair value gaps, which remain open. Then the price shows respect for these zones, doesn't fall below them, and thus confirms that manipulation in the weekly cycle did indeed occur. After that, you can open a trade with the aim of removing the very liquidity that I mentioned at the beginning. In this case, the setup gave a ratio of approximately 1 to 4. But again, just look at the entire movement that occurred next, and you will see that one such correct entry brings much more than attempts to trade every day, ignoring the cycles of the week. If you still find it difficult to understand the structure, understand price behavior, or simply don't have enough time for a full analysis, you can use the OWL indicator. It's important to understand that OWL doesn't work with liquidity and is not related to the smart money approach. It's a separate system, a trend-following system with clear risk management and understandable entry conditions. No guesswork and no manual marking. The indicator itself determines the entry point, stop, and take strictly according to its logic. It works in any market, forex, gold, crypto, and is perfectly suited for those who want to trade with the trend, but without complex analysis or long study of charts. And if you want to get the OWL Helper Expert Advisor, just message me on Telegram. Hi, send me the OWL Helper Expert Advisor. I bought the indicator and the date of purchase. The link to the indicator itself is in the description below the video. Now, a few words for those who trade crypto. In the crypto market, quarterly theory in its pure form doesn't always work, because the structure of sessions is different here. Therefore, the main focus is on context and areas of interest. If you know how to read price movements, understand where the market is manipulating and where the real movement begins, that is more than enough. And here it is convenient to trade through AMDX. It's a decentralized exchange that I use myself. It has a simple interface, fast execution, and minimal commissions. Most importantly, there are no verifications, limits, or restrictions. You connect your wallet and start working right away. If you trade structures and use a logical approach, EURUSD fully meets all your needs, from convenience to speed of opening trades. I have left a link to the exchange in the description below the video. I hope now you understand what the market looks like when viewed not through individual patterns, but through the logic of cycles and context. Quarterly theory helps you understand where the market is. Context shows what it's going to do. Together, they create a transparent picture where manipulation, liquidity, and direction are much easier to read. It's not necessary to trade every day. It is much more important to be able to wait for the moment when the algorithm makes its key move. One correct entry within a weekly cycle will yield more results than dozens of chaotic trades. If you are interested in this approach, like the video and write in the comments what you would like to see in the next episode. I read everything and try to create content that really helps you understand the market rather than complicating it. Work with logic, not emotions. See you in the next video.